Week struck gold. The 2021 annual Berkshire Hathaway shareholders meeting featuring the legendary Warren Buffett and Charlie Munger is in our hands. While the Yahoo broadcasts spans over 5.5 hours, today's video zeroes in on a specific clip that tackles the burning question of inflation. Undoubtedly one of the most eagerly anticipated inquiries for Buffett and Charlie. Is inflation on the horizon? And should we brace ourselves? In this segment, the venerable 90-year-old Mr. Buffett addresses the question of the decade. I'll be presenting a query sourced from Chris Freed in Philadelphia, inviting anyone on stage to weigh in on the matter. The question at hand: are there observable indications of inflation gaining momentum in the raw material purchases made by Berkshire subsidiaries? I'll tackle the initial response, and then Greg can delve deeper into the topic. We're in the midst of a significant inflationary period. It's quite fascinating. We find ourselves raising prices, and in turn, suppliers are increasing prices for us. Strikingly, this upward pricing trend is being met with acceptance. Take the example of home building, a sector where we have a substantial presence with 9 home builders, including the largest manufactured housing operation in the country. The costs involved are on a relentless upward trajectory. Buffett's keen awareness extends to the pricing challenges confronted by his diverse businesses, notably his Clayton Homes, a leading home builder in the nation as of 2021, specializing in framing. This facet constitutes approximately 20% of a home's overall cost and is heavily influenced by lumber prices. A glance at the lumber price graph unveils the gravity of the situation, with prices skyrocketing exponentially. Within a year, the cost has surged from around $785 per 1,000 board feet to $1,500. Since 2016, there's been an astounding 600% increase, as per analysis conducted by the NAHB. In the past year alone, the price surge has tacked on an additional $36,000 to the cost of an average new single-family home. Despite a soaring demand, some home builders are scaling back production due to the daily escalating and prohibitive costs. Although single-family starts saw a 41% increase in March compared to the previous year, builders are grappling with formidable challenges in augmenting the supply. Cheryl Palmer, CEO of Taylor Morrison, encapsulated the severity of the situation in a recent CNBC interview. Over the last 4 or 5 months, we have witnessed something unprecedented in my career. Lumber has ventured into uncharted territory. These substantial pricing pressures are not confined to the housing sector. They extend to other commodities like steel. Let's delve into Buffett's further insights. Steel costs are on an upward trajectory every day, and this trend is yet to abate because wage adjustments typically trail behind. In the case of, say, the United Auto Workers, UAW, negotiating a 3-year contract, we are locked into that duration. However, for companies purchasing steel, the costs escalate on a daily basis, creating an economically red-hot environment. This unforeseen intensity caught many of our companies off guard. As we allowed various operations to resume work, anticipating a gradual return to normalcy, our companies, including the furniture stores, faced uncertainties after a prolonged closure. The unexpected surge in demand, coupled with supply chain disruptions, led to a backlog of orders. Despite challenges in delivering products promptly, the prevailing sentiment among consumers is a willingness to wait, recognizing that delays are industry-wide and not unique to any particular supplier. We initially expected demand to taper off with the conclusion of the $600 payments. However, what we observed around August of last year was contrary to our projections. It not only persisted but continued to surge. The trend has persisted, and I receive weekly updates on the situation. Conversations with Bumpkin involve a meticulous review of daily activities at various stores in Chicago, Kansas City, and Dallas. The unrelenting buying spree is evident, driven by consumers with disposable income willing to absorb higher prices. We recently implemented a price increase for April, addressing the rising costs and disruptions in supply chains affecting various industries. The surge in demand has created a frenzy in purchasing, although challenges exist in specific sectors where acquiring goods becomes increasingly difficult. The dynamics of the global economy are shifting funds from certain sectors, such as international air travel, redirecting wealth into other segments. This redirection has left individuals with more disposable income. However, the impact is not uniform, and certain sectors are experiencing challenges. Similar to lumber, the steel industry is grappling with a steep and exponential increase in costs. In April of the previous year, a ton of steel rebar was priced at approximately $3,500. Fast forward to the present, and the same ton now commands $5,400, an alarming 54% surge in just 1 year. To put it in perspective, going back to 2016, the cost was $1,600, highlighting a nearly threefold increase in prices. These consistent spikes in pricing, witnessed week after week, are posing significant challenges for companies globally. The repercussions are cascading down to consumers, who are not only willing to bear the rising costs but are also patient enough to endure months-long waits for the arrival of products. The surge in raw material costs is not limited to specific sectors. It encompasses a broad spectrum of materials, indicating a sustained upward trajectory as the world economy reawakens. From steel and copper to corn and lumber, commodities launched into 2021 with remarkable strength, reaching levels not witnessed in years. This upward surge poses a threat to elevate the costs of everyday items, ranging from lunchtime sandwiches to towering skyscrapers. The looming question: does this rally signify an impending inflation disaster? Buffett weighs in on the situation, stating, "It is not a price-sensitive economy right now, in the least, and I don't know exactly how, when it shows up in different price indices, but there's more inflation going on than quite a bit more inflation going on than people would have anticipated just 6 months ago or thereabouts." Yeah, there's one very intelligent man who thinks it's dangerous. And that's just the beginning. You've likely noticed, and I think you touched on it, the escalating pressures on steel prices, timber prices, and any petroleum input. Fundamentally, there's significant pressure on these raw materials. Another aspect you've mentioned, which circles back to raw materials, is the scarcity of certain products. This scarcity is influencing prices and affecting the ability to deliver the end product. The challenge of scarcity is real in our businesses, and it may be partly attributed to the Texas storm we previously discussed. When you take down that many petrochemical plants in one state, and the rest of the country is heavily dependent on them, we're witnessing the repercussions both in terms of price and an overall scarcity of products, which are interconnected. But there are challenges. That's for sure dangerous. That's the word Munger uses to describe what's happening out there. He then defers to future CEO Greg Abel to elaborate further on the question, discussing the potential reasons behind these price points and their acceptance. While Abel provides a perspective aligning with the Fed's narrative, attributing the surge in prices to post-pandemic demand and temporary supply constraints, Munger's choice of words plays a crucial role in providing a genuine insight into Berkshire's view of the economic landscape. Abel leans toward the Fed's version of the story, suggesting that the surge is post-pandemic and supply constraints are temporary, leading to what the Fed terms transitory inflation or base effects, a price surge that will subside as economies stabilize and factories catch up with consumer demands. But there's an alternative perspective to consider in dissecting this response, and it begins with Buffett's initial demeanor toward the question. His demeanor suggests a level of skepticism regarding the transient nature of these effects. Inflation, to a significant extent, hinges on human psychology. If, for instance, housing prices continue to climb month after month, fostering the perception of an ongoing cycle of price surges, individuals might rush into housing, contributing to this cycle. This situation becomes precarious as prices escalate rapidly, eroding trust in the currency and potentially leading to what many believe the United States is impervious to: hyperinflation. This isn't to imply that Buffett foresees the demise of America. When considering the entire broadcast, his long-term optimism about the United States is evident. However, based on some of his responses, there seems to be an underlying suggestion of an impending interest rate hike for short-term relief. The Federal Reserve may need to implement a significant measure to alleviate these pressures, and an early interest rate increase could be the primary solution, an action that might elicit negative reactions from the markets, causing a downturn in stock prices and potentially triggering a substantial correction. Thank you, everyone, for watching, and as always, please ensure you hit that subscribe button if you found this insightful.